Welcome to this video. Today, we are going to talk about something crucial, what you absolutely need to know before investing in the stock market. If you're thinking about putting your money into stocks for the first time, or if you already invest but want to do it smarter, then this guide is for you. Investing in the stock market can be one of the best ways to grow your wealth over time. But it is not a guaranteed fast path to riches. Without a clear understanding, and without discipline, many new investors make serious mistakes that can cost a lot more than just money. They can cost confidence. So in this video, I will walk you through 10 fundamental things you should know before you start investing. These are practical principles, grounded in reality, designed to protect you, to help you make better decisions, and to build a solid foundation for long-term success. By the end of this, you will have a clear roadmap, not just for how to invest, but how to think about investing. Let's begin. Number 1. Define your financial goals. Before you even open a brokerage account or pick a stock, the first step is to define your financial goals. Why are you investing? Is this money for retirement 10, 20, 30 years from now? Or is it for something more immediate, buying a house, funding education, or simply growing a side pot of wealth? Your goals shape everything. Time horizon. How long do you plan to stay invested? If you're investing for 20 years, you can usually afford more risk. But for 5 years, the strategy should be more cautious. Amount needed. How much money do you aim to grow? This helps you determine how much to invest and how aggressively. Risk level. Different goals come with different tolerance for ups and downs. Retirement money might ride through market crashes. Money for a down payment must be more stable. If you don't set clear goals, you risk acting emotionally. You might chase hot stocks because you heard someone made a killing, or panic sell when things go south. Setting goals makes your decisions rational and grounded. Number 2. Build an emergency fund. One of the most important foundations before investing is to have an emergency fund.
Why?
Because life happens. Suddenly, you might face a medical bill, a car repair, or a job loss. If all your money is locked in the market, especially in volatile investments, you might be forced to sell at a loss to cover your needs. A common rule of thumb is to save 3 to 6 months of living expenses in cash or a very liquid account before investing. Some people even aim for more depending on their job stability and cost of living. Where to keep that fund? Ideally, in a high-yield savings account or a short-term fixed deposit, somewhere safe, accessible, and not exposed to market risk. If you skip this step, you may be tempted to cash out your investments under pressure, defeating the benefits of long-term investing. Number 3. Know your risk tolerance. Risk tolerance is about more than just mathematics. It's about your emotional and financial capacity for loss. On the financial side, how much capital can you afford to lose? If you put up money that you might need next month, a sudden drop shocks you much harder than if it's money you plan to leave for a decade. On the emotional side, how do you react when your investments drop 10%, 20%, or more? Do you panic and sell, or do you stay calm and ride it out? Understanding risk tolerance helps you choose the right mix of investments. If you're conservative, you might favor safer assets, index funds, bonds, blue-chip stocks. If you're more aggressive, you might allocate more to growth stocks, small cap, or riskier sectors. According to financial guides, beginners should not allocate more than a small portion of their capital to any single risky stock to manage downside risk. Number 4. Educate yourself. Learn the basics. Investing without understanding is like driving a car without knowing how to brake. To invest wisely, you need a foundation in the basics. How the stock market works. Stocks are shares or ownership in companies. When you buy a share, you own a small piece of that company. Stock prices rise and fall based on business performance, investor sentiment, and broader economic factors. Key financial metrics. The P/E ratio, price to earnings, helps you understand how much investors are paying for a company's earnings. Schwab Brokerage. Balance sheets, income statements, and cash flow statements give insights into a company's financial health. Earnings per share, EPS, shows how much profit is allocated to each share. Investment vehicles. You don't have to pick individual stocks. There are ETFs, exchange-traded funds, mutual funds, and index funds. These let you pool money and spread risk across many companies. Decide whether you want to be a long-term investor or more of a trader. Compounding. Reinventing earnings is powerful. When you earn returns and then those returns generate more returns over time, that's compounding. Learning this isn't optional. Without it, you expose yourself to unnecessary risk and likely regret. Number 5. Avoid leverage/debt risk. Some new investors are tempted to borrow money or use margin to invest more. That can multiply gains but also losses. For example, borrowing to invest means if the market falls, you not only lose your invested capital but also owe interest on the borrowed money. Pyramid finance. If a margin call happens, you might be forced to liquidate positions at very bad times. Leveraging is not inherently evil, but it's very dangerous for beginners. Unless you fully understand the risks and can absorb worst-case scenarios, stay away from borrowing to invest. Number 6. Diversify wisely. Diversification is one of the most powerful tools to reduce risk, but it's not just about buying many stocks. Here's how to think about it. Spread it across sectors. Invest in different industries, tech, healthcare, consumer goods, so a bad event in one doesn't wreck your entire portfolio. Use ETFs or index funds. These give you exposure to hundreds or thousands of companies in one fund. Investmentists. Geographic diversification. Invest in companies from different countries to reduce risk tied to any single economy. Balance with asset classes. Stocks are only one part of a diversified portfolio. Bonds, cash, or other assets can provide stability. But don't overdo it. Owning too many funds or too many securities can make your portfolio hard to manage and dilute your growth potential. Number 7. Don't try to time the market. Many beginners think they can buy low, sell high by predicting market swings. But timing the market consistently is very difficult, even for professionals. A smarter approach is dollar-cost averaging. You invest a fixed amount at regular intervals, regardless of market conditions. Over time, this strategy tends to reduce the risk of buying at market peaks. Some key ideas. Stay invested long-term rather than chasing short-term opportunities. Avoid making investment decisions based on market headlines or trying to catch the bottom or sell the top. Use a disciplined, rule-based strategy. Number 8. Understand costs, fees, and taxes. Investing isn't free. There are many hidden costs that can erode your returns. Brokerage fees. Depending on your broker, each trade might cost money. Fund expense ratios. Mutual funds and ETFs have ongoing management fees. Transactional costs. Spread, slippage, and other costs can add up. Taxes. When you sell for profit, capital gains tax may apply. Short-term trades often face higher tax rates than long-term holdings. Before investing, calculate how these costs will affect your returns. Sometimes, a strategy that looks attractive on paper becomes less so after fees and taxes. Number 9. Manage your emotions. Probably one of the hardest parts of investing, controlling your emotions. Fear and greed are powerful. Fear can make you sell in panic during a market dip. Greed can lure you into speculative bets or hot stocks. FOMO, fear of missing out, often drives bad decisions more than careful analysis. Many financial experts emphasize having rules. Decide in advance what portion of your money you'll put in high-risk investments. Set clear criteria for when to buy or sell. Don't make decisions based on social media hype or rumors. Stay calm during market volatility. Remember, markets go up and down. Drawdowns are part of the game. Behavioral discipline often matters as much as financial analysis. Number 10. Review and rebalance regularly. Investing isn't a set and forget activity. You need to review your portfolio periodically and rebalance when necessary. Over time, some investments will grow faster than others, shifting your asset allocation. Rebalancing helps you maintain the risk profile you chose initially. Also, revisit your goals. As you get older, or as your financial situation changes, your goals and risk tolerance might shift. Adjust strategy accordingly. It's not failure to change, it's maturity.
Bonus principles.
Here are a few extra but very important ideas. Continuous learning. Never stop educating yourself. Join online communities, read books, and follow trusted sources. Be skeptical of too good to be true offers. If someone promises sky-high returns with zero risk, that's a red flag. Risk management rule, 2%. A widely used guideline is to risk no more than 2% of your total capital on any single trade or high-risk position. Conclusion. Investing in the stock market has huge potential, but it also comes with real risks. By understanding these 10 principles, you give yourself a strong, wise foundation. Define your goals. Keep a safety net. Know how much risk you can handle. Educate yourself. Avoid debt and leverage. Diversify. Don't try to time the market. Be clear about costs. Master your emotions. Review and adjust as needed. If you follow these, you're not just playing a game. You're building something serious, something long-term. Thank you for watching. If you found this helpful, like and subscribe and leave a comment. What's your biggest fear or question about investing? I'll be making more videos to address them.